Bitcoin in your 401k. Is that a good idea? The folks at Fidelity certainly think so. So we're going to talk about it on the program along with the Fed raising rates. This past week, the Fed raised rates a half a point, the biggest increase in rates over the course of like 20 years. So what's the impact of that, and how might that affect you as well? Plus, we're going to be joined on the program this week by our fellow certified financial fiduciary at Nelson Financial Planning, Kristen Cayley. She also happens to be a CPA, so she's going to answer the question of why 2022 was such a taxing year as it relates to the preparation of your tax return, along with maybe help you answer the question of where's your refund if you haven't gotten it yet. Millions of Americans are still waiting. What can you do to help maybe speed that along? So welcome to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries like Kristen Cayley stand ready this week to help you change your life with a successful and cost-effective financial plan. So, before I forget, I need to make sure to wish everybody a happy Mother's Day. So, at our house, we've got two kids. One came back from college. The other is not back until this coming Wednesday. So wanted to take a moment and wish Stephanie, mother of the three boys, a happy Mother's Day. Also take a moment to wish my mother happy Mother's Day. And of course, June, my mother-in-law, happy Mother's Day to those three, along with all of the mothers out there. So wanted to make sure that I hit that date because last week I totally forgot an important date that was May 1. And that was the date 38 years ago in 1984, where this company, Nelson Financial Planning, used to be known as Nelson Investment Planning Services, NIPS, if you will, turned 38 years of age last week. And here's the crazy thing, it just kind of snuck up on me, and all of a sudden the date had passed and the show had closed, and I was like, oh, wait a minute, oh, I should have said something. But anyway, so we're saying it now, and I made double sure to make sure I mentioned Mother's Day, because that one you don't really want to miss and slip into the following Sunday, because that would make some moms out there not thrilled with me. Anyway, Fed raising rates. We'll get on to the financial topics. 0.5% on this past Wednesday of this past week. That's the largest single increase, as we said at the top of the show, since the year 2000. Normally they only go in quarter points, been doing that for 20 odd years. But unfortunately, with this inflation thing, gotta kind of get your act together a little bit quicker. So they raised interest rates by a half a point. What's even more kind of interesting, or I guess maybe bizarre, if we can use that word to describe market behavior in the short term, that's probably a pretty good adjective to use when we talk about markets in the short term. Markets responded on Wednesday, moving up 3% from the time you heard the chair of the Federal Reserve make his comments from the time the market closed. So basically within like 2 hours, the market wound up moving up 3%. And certainly that begs the question, like, why or how did that happen? Well, I think it was no mystery that 0.5% increase was coming. Certainly the media and a lot of the folks on the Federal Reserve Board, in fact, had been talking and communicating that across the board to the media in the weeks leading up to the Federal Reserve meeting in May. And so the markets had probably priced that in. And so what the markets liked about some of those comments that were said after the Fed meeting by Jerome Powell, the chairman of the Fed, was that they didn't necessarily see a need to start to jump up even more. I think there was some speculation of maybe in June there needed to be a 0.75% increase, which would be a pretty big jump in interest rates on the heels of two prior interest rate increases. And so Powell kind of said basically, no, we're not doing that, or we're taking that off the table. And the markets sort of responded somewhat positively to that. I think also the markets had already are in the process of sort of wrapping their hands around this higher interest rate environment that we're going into. And so some of sort of the negativity certainly had played out in the markets during the course of the month of April. If you're looking at the performance for that month, it was a pretty tough month in terms of the NASDAQ, for example, which is focused heavily on tech companies that rely on cheap sources of capital to boost their bottom line. That group of companies experienced the worst month since back in 2008. So pretty significant reaction in the market, sort of in anticipation of this half a point increase. And so we see once again where once the actual expectation happens, then there's a relief that it wasn't worse or it wasn't more than what was expected. So I think that was kind of the action in the market that we saw this past week on Wednesday. And then the market spent the rest of the week, basically moving up and down kind of thing. Here's the point. And this is why we say timing the market is so difficult, why it's so important to be consistent. Most of the markets, if you look through the history of the market over the past 100 years, what you'll find is an interesting phenomenon where, in fact, most of the single best days in the market are clustered around some of the single worst days in the market. And when you stop and think about that, you may be surprised by that, but the reality is that you shouldn't be, because volatility has two parts. Volatility, when we talk about volatility in the markets, that's typically has a negative connotation, but it also means that there's some days where there's some pretty dramatic relief or upward movement days in the markets as well. And that's certainly kind of what we saw play out, particularly on Wednesday of this past week. So certainly some interesting market behavior on the day that the Federal Reserve raised rates by 0.5 percentage point. Certainly the takeaway, I guess, from the markets is glad it wasn't 0.75 or taking that one off the table, and that the Federal Reserve was basically rolling over a lot of its holdings rather than selling them in the bond market. So hence you saw that market performance on Wednesday. So what's it all mean for you? At the end of the day, higher interest rates are bad news for debtors, and maybe finally a silver lining, if you will, for savers, right? Because if the interest rates are going up, if you're borrowing money, although the mortgage market certainly priced in this interest rate increase way back in March, when we saw interest rates on 30-year fixed rate mortgages go from 3% to 5%, literally overnight. It was in a 45-day period of time. Maybe that's not quite overnight, but that's pretty darn fast, where you see mortgage rates increase that dramatically, already sort of pricing this in, anticipating, if you will, moving on the rumor and ultimately doing it ahead of time before you actually see the actual action, before you see the actual movement in the interest rates. If you've got credit card debt, well, you shouldn't. You need to pay that off. But car loans, all those interest rates go up. The silver lining, if you are in cash and you've got a money market or a savings account, maybe you might start making a little bit of interest on those gradually over the next few months. So make sure you stay okay on the cash side, because that bond side doesn't look very well, especially with interest rates moving up. With that, we'll take a break and continue here on Dollars and Cents after these messages. Bitcoin in your 401k. We've got one word for that, and that word is yikes. A lot of talk about crypto these days, but 2 weeks ago or so, the folks at Fidelity took it to a whole new level by suggesting they would add Bitcoin to their 401k investment menus later this year. What makes the story even more fascinating is that Fidelity itself doesn't actually allow individual investors, IRA investors, to buy crypto in their IRAs. So what gives on all of that? Well, we'll talk about it here on this segment of the program on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout Central Florida. Also happen to be one of the top 25 financial planning podcasts, where I think at last count we were over 21 or 22,000 downloads on various platforms. So make sure you subscribe to us on your favorite social media or podcast platform of choice. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team stands ready this week to help you change your life with a successful and cost-effective financial plan. So Fidelity made the big announcement about adding Bitcoin to their 401k menus, which is really a pretty interesting development, because Fidelity is perhaps one of the biggest 401k providers in that marketplace today. Over 23,000 employer plans use Fidelity to provide 401k platforms to their employees. And what's interesting about it is that 401k platform usually has some shared liability, meaning it's not just the investment manager that's on the hook, it's also the employer and the trustees that are on that plan itself. So you've got a little bit of way to sort of spread the liability around a little bit versus in an IRA. Because what's interesting in the story is they don't allow crypto to be bought in IRAs, but they're saying, oh, we're going to make it available in 401ks. And so that's an interesting development. The other piece, and this is really more of a commentary, that is my view, Fidelity has a decent reputation as an investment manager, but it's an even better marketing company. And the reality is that in the financial services industry as a whole, the industry is one of the fastest to try and embrace the next big shiny thing, or certainly figure out a way to do it, because after all, this industry is based upon acquisition of dollars. So if you see a bunch of dollars going into something that you don't provide as a product offering, what do? Well, you figure out a way to offer the product, because if that's where the money's going, then that's where you want to be. And Fidelity, as a marketing company, is very, very good at that. The problem is, we've been doing this long enough to have seen many times where that backfires. The financial services industry was rolling out tech funds, internet.com funds in the late 90s. If you own one of those funds, then you know very well that that did not play out very well. But every single investment management company was rolling out a technology or an internet fund at that point. Why? A lot of dollars flowing in. See the same thing in the insurance industry. Equity indexed annuities, folks looking for some kind of an option after 2008, skittish about the markets and the decline and the deep recession that occurred in 2008. So then you saw the insurance industry roll out products that sounded like they're the same old annuity, but if you wrap in some equity index language, if you will, into it, well, then you can certainly sell a whole lot of them. Again, history has a tendency to repeat itself, and certainly this conversation about crypto and incorporating into the 401k, a marketing move, not an investment move, a marketing move by the folks at Fidelity. If you don't believe my opinion on it or take my word for it, well then, you can trust your government's word, can't you? Yeah, maybe not. Anyway, not sure that's a good option. But the Department of Labor, which, by the way, is the government entity that manages and runs and oversees 401ks, started spinning on Fidelity's announcement. Along with Senator Warren this past week as well. Her head started spinning on this one too, although her head's always spinning when it comes to private enterprise. I digress. Fidelity's announcement Department of Labor, they are the ones, of course, that regulate employer plans. The exact statement from the Department of Labor on this is, we have grave concerns over what Fidelity has done. That's pretty strong. Grave concerns. Even Vanguard, which obviously stands as a competitor to Fidelity, a lot of 401k platforms provided out there by Vanguard, jumped in as well, since crypto, their statements, since cryptos are highly speculative in their current state, Vanguard believes their long-term case is weak. Not my words, Vanguard's words and Department of Labor. I would also comment that your 401k should be steered into more traditional assets rather than highly speculative assets. The reality is that when you think about your 401ks and things like that, what you really should be doing is sticking with things that have more traditional performance, stocks, bonds, things with track records. Even then, things that are long established have volatility in them, but the new and shiny things are always going to have a higher level of volatility. And now clearly this, a highly speculative investment looking to add in. Why? Again, because of the financial services approach of chasing the dollars. We see it time and time again, and that's certainly what Fidelity is looking to do here in terms of offering that as a platform item on their 401ks. Now, the reality is, okay, and we'll couple this conversation with NFTs. We're going to be talking about those a little bit more next week on the program. Got some interesting data to share with you on that. And underscores the notion of anytime you have highly speculative asset classes and you see them running up, you typically see those running up during periods of easy money. Simply put, people have a bunch of extra money, don't know what to do with it, and they start throwing it at stupid stuff. And the reality is that's certainly what you're seeing across the board. Stuff that is not sustainable, stuff that doesn't have track record, stuff that you have to suspend your normal belief system in order to have it make sense. Crypto, NFTs as investments, highly speculative. Prior podcasts, we've talked about it at length. We will just take a minute and recap. There's no track record. The argument that crypto is somehow some great, marvelous inflation hedge really is a head scratcher, because crypto was started in like 2009. There hasn't been any inflation since 2009, like none. And when you've started to see inflation, which would be last fall, the biggest crypto, Bitcoin, is down 40%. So someone's going to have to explain how it's this marvelous inflation hedge, because when I look at the performance relative to periods of inflation, it's actually gone completely the opposite direction. So there's simply nothing to show in terms of its track record and its performance. And if anything, its performance in an inflationary environment has been a complete disaster. So it's not some marvelous inflation hedge, no matter whether somebody says it or not. And don't even get me started on the fact that there's nothing to show for it. Folks, if there's nothing to show for it, nothing backing it, nothing backstopping it, then that's the very definition of a bubble. We're inflating something that is just arbitrary, with no barriers to entry in any way, shape, or form. Stick with the fundamentals. Sorry. Again, as we celebrate our 38th anniversary as a firm last year, pretty sure that's the path to long-term investing success. With that, we'll take a break, and then when we come back, we will be joined by our fellow certified financial fiduciary, Kristen Kelly, to talk about some tax stuff. All that and more next on Dollars and Cents. So 2022, a taxing year for tax preparation. We're joined by our fellow certified financial fiduciary at Nelson Financial Program. Also happens to be a CPA, so we've got some good insight into why 2022 was such a taxing year. So welcome to the program once again, Kristen. Always a pleasure to have you on.
Yes, thank you for having me back, Joel.
So it is Mother's Day, right? So, did you get Walter like a bunch of like treats and stuff like that, or what? How's Walter doing?
He's doing great. Had a great Mother's Day so far. He's got a shirt that says "I heart my mom," so
Nice.
I'm kind of really milking it.
Nice, nice, nice. So Walter is of the four-legged variety.
Yep.
Jack Russell, right? Mm-hmm. All right. So that's a lot of good energy. Probably as much energy as like a young child, I would imagine, at this stage in the game.
I would say so.
Very good. Well, tell us why the year 2022 was such a taxing year for many in the tax preparation business.
So I think there's a couple reasons. But the main one is we moved back to the original tax deadline. So for the past 2 years, we've had extended deadlines. So back in 2020, when we were doing the 2019 filing season, it was extended to July 15th. And then last year during the 2020 season, it was extended to May 17th.
And a lot of tax preparers are of the view that, this whole thing is just an outright disaster because of these changing dates. That make it really difficult to get people used to a particular pattern of behavior, if you will. Couple that with, of course, the IRS is so far behind in terms of processing things.
Very far behind, and then tons of legislative changes. So just tons of changes in a short period of time with changing deadlines, just a lot of confusion.
Well, and I guess for many CPAs and tax preparation firms, they had to then sort of establish a cutoff date, if you will.
Mm-hmm. Yep, with just loads of tax returns coming in, a lot of CPAs did implement a cutoff date, some as early as March 1st.
Wow.
So
wow.
That's very, very early.
You barely had all your tax forms by then. And if you were getting K-1s, then there's no way you were getting the return filed in that case.
Mm-hmm.
Yeah,
so we are going to see a lot more extensions this year. People that may have never extended before now have to extend just because of these cutoff dates, or the tax forms didn't get in on time, or confusion over the deadlines. Might have thought it was another extended deadline when it was actually the April 15th deadline.
Back to the original. Even though they were very far behind, you still had to stick with it. Now, we had a cutoff date, right? But ours wasn't March 1, obviously. We were well into
5th.
April. April 5th. Okay, so
I think ours was later than most.
and that was an internal conversation at the office where yes, I think we were trying to establish that date. I always lean towards, but I'm not sitting there doing the work. So it's easy for me to establish the date. So I think we did have an April 5th cutoff date. And so a few folks had to get extensions that were not normally, that was not normally the case. But that's important in order to be able to get the returns done properly, especially with some of these issues involving tax law changes.
Exactly. Yeah. So that's the other major thing for this tax season, just major law changes accumulated from the 2019-2020 tax filing seasons. So just a couple things that have changed from year to year. So things like the unemployment taxation being excluded in 2020, not in 2021. So just things like that all accumulated to just a rough tax season.
Well, and then you have the thing that we encountered a lot was the stimulus check. Once again, it was another year with stimulus checks. Mm-hmm. But it's not like those stimulus checks came to you like later in the year. That was those stimulus checks were coming to you early in the year, like basically a year ago in terms of when you were filing the return. So easy to kind of forget that, right?
Yeah, it would have been probably around March or April of last year.
Had a lot of situations where we would say, "Did you get it? No, I didn't get it. You sure you didn't get it? No, I didn't get it. Are you really, really sure you didn't get it? Maybe." So that throws it off because you have to account for that on the tax return.
Mm-hmm. Yes, and it has to match up with the IRS records. Otherwise, they have to manually go back and reconcile the difference. So that could be a major holdup. The other thing is the IRS did send out letters about that stimulus check, but it didn't always match up with what people actually received. So just a lot of time spent trying to figure out what actually happened with that third stimulus check.
Well, and the reality is that for those folks who got that IRS letter and still wanted to take the position that, oh, well, I didn't get it, or it never got to me, or the dog ate it, or whatever the case may be, there really wasn't a lot of recourse.
No, from what we saw, the IRS was actually responding pretty quickly to
Right.
those when they didn't match up. About 3 to 4 weeks, you'd receive a notice that said you owe this tax bill.
Yeah, we talked about that on a previous podcast where we saw that play out, where literally within 30 days after this particular person had filed their return and said, "Oh, I didn't get it," and we said, "Well, are you sure?" And so we went ahead and said, "Okay, great, we'll put it," because if we hadn't done that, then there's no way they're ever going to get recourse on being able to get the stimulus check. And when you stop and think about it, for a married couple, that's $2,800. I mean, that's not an insignificant amount of money. Mm-hmm. So, but 30 days, within 30 days, he'd gotten a letter. And so they said our records disagree, and tough.
Basically said, send us $2,800.
Right. So that's a significant difference in terms of how it all plays out. And then of course the reality is that the IRS itself, aging workforce and aging systems and things like that, where it takes a long time to process those returns.
Mm-hmm. Yep. So going into the 2021 tax season, the IRS had a backlog of about 24 million tax returns.
Mine was one of them. I finally got my refund after like 6 months, but yes, mine was in that pile of 24 million. Mm-hmm. Yeah.
So just kind of an overview. Amended tax returns are taking about a year to process.
Wow.
And that's electronically filed amended tax returns. So if you paper filed an amended tax return, I mean, it's going to be over a year, maybe even 2.
Whoa, that's a really long time to kind of have to wait. And then the problem with that is that oftentimes there's information that would then carry over to the next tax year that could really kind of make things even more difficult, almost have a ripple or domino effect, if you will, going forward. So with all of that, I mean, what are some of the things that taxpayers really need to kind of be aware of and to try and make sure that they're doing going forward? Because I don't think these problems are all of a sudden going to disappear next year.
Right. So with the move back to the original deadline, we don't expect there to be extended deadlines in the future. So get your taxes done as soon as possible. If you're using a CPA firm or an accountant, get them your documents as soon as possible in case they implement that cutoff date again.
Right, because you could then be surprised of, oh, now I've got to file an extension, especially if some places are having deadlines, cutoff dates as early as March 1. That's very early in the tax season to take that. What are some of the other things that taxpayers should sort of expect kind of going forward in this sort of, I guess, new normal, if you will?
Right. So probably higher tax prep fees. So with all the law changes, there's costly software changes, just more time spent on each tax return. We saw that this year with the stimulus checks, just that was a step that nobody really had to do before, and now you're constantly kind of asking the same question. It takes a lot of time. So just higher prices probably.
Yeah. And we've, as a firm, have always kind of strove to do that as kind of a value add for our clients because it's not core of what we do, but we certainly do a number of tax returns. I think we did over 525 coming into April 15th. So. So to your point, maybe we should have had an earlier cutoff date and not had quite that volume, but yeah, we see those costs, and in an inflationary environment, as a business, you want to try and not just immediately push all of that to your customers, but it's hard to avoid those costs on the software and the research that's involved with all of these new issues. So anyway, we're going to take a break. When we come back, speaking of taxes, we're going to ask the question of where's your refund and how do you track it down? Coming up next year on Dollars and Cents. Where is my refund? If you're asking yourself that question, then you need to listen to this segment of the program. If you're anything like me, you had to wait 6 months for your refund. So we're going to try and give folks some background as to why those refunds are taking longer, along with perhaps what you might be able to do to try and at least track it down. Not a good way to speed it up, but at least have some knowledge of what's going on with the return. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida. Also, one of the top 25 financial planning podcasts. So make sure you subscribe to us on your favorite podcast channel of choice. My name, of course, is Joel Garris, certified financial planner and certified financial fiduciary at Nelson Financial Planning. Joined this week by a fellow certified financial fiduciary, who also happens to be a CPA, so obviously expert in tax matters, Kristen Cayley. Welcome, as always, to the program.
Yes, thank you, Joel.
Good stuff indeed. So last segment, we were talking about the difficulties of why 2020 was such a taxing year on the tax preparation side of things. A lot of things that had to get tracked down, back to the original filing date, if you will. Some things that taxpayers can do a little bit differently is make sure you stay organized throughout the year. Because these issues are not going to go away going forward. You're not going to see an extension or a movement of that tax deadline. If you didn't see it this year with all of those changes, unlikely that you're really going to see that going forward.
Right.
So make sure that you're organized and ready to go. Now, if you did your tax return and saw you were getting a refund, you probably shouldn't go out and spend that money, should you?
No. So the IRS website says typically 21 days or 3 weeks for the refund. But they also came out and said around March 15th or so, don't expect the refund within that time frame, and don't rely on the refund for any major bills or purchases.
Right. Don't go buy a new fridge with your IRS refund because when the bill comes, you're probably not going to have the refund yet. Right. Yeah. So what were some of the more common reasons? Like how does this happen? I mean, what are some of the reasons why a lot of these returns are sort of just getting kind of gubbed up in the process, if you will?
So a lot of it has to do with the major tax legislative changes. So the advanced child tax credit payments were one of the bigger ones this year, where it just confused a bunch of parents. So that was the payment that came due between July and December, about $250 to $300 per child under the age of 17. So that was received over the course of 6 months, and then parents were supposed to reconcile it on their tax return. So a lot of parents didn't know the exact amounts they received. They received letters from the IRS that didn't necessarily match up with their bank accounts or checks they received. So just a lot of confusion. So if that letter or that amount that you reported on your tax return didn't match the IRS records, it automatically held up whatever your refund is until the IRS manually checks it.
And what was bizarre as we started to see those letters come in this past tax season is that it was like a split document, right? Like if you got $3,000 or something like that, it would show as $1,500 to one person and $1,500 to the other, which is kind of a bizarre way of doing it on a joint return. And I remember when we first saw them, I was like, well, is this the amount, or is this not? Are we doubling this? What are we doing with it? So certainly an odd way to present the information.
Yes, and people that filed their tax return after the deadline last year, it was even more confusing because they based that payment based upon whatever your income was. So if your income varied from 2019 to 2020, the payments all were changing month to month. So very hard to reconcile.
Right, and then you really had to reconcile it, and because much like the stimulus, or I guess I would say in contrast to the stimulus checks, you really did have to reconcile it, because if you got it and you shouldn't have, you had to pay it back.
Exactly.
Which is a pretty significant difference versus the stimulus checks.
Right.
So what else is kind of on the list on some of the reasons why all of these tax returns got held up? I guess stimulus checks would be the next one that would immediately spring to mind.
Yep. So we have data from the 2020 tax year that says more than 10 million returns were held up because of not being able to reconcile their stimulus checks.
Just on that one single item.
And I'm sure a good amount of those were refunds.
Right. People trying to think that claim it that might not have gotten it. So that made things a little bit more difficult. Yeah. No, that's very true. What are some of the other reasons why a potential refund may be getting held up?
Because you owe the IRS money.
Yeah, they don't like that.
No.
If you owe them money, they will look for opportunities to grab that whenever they can.
Yep. So if they do that, they'll send you a notice in the mail just letting you know you're not going to get the refund. They're going to keep it.
Nothing like the IRS, right? But they're right. If you owe it, then they're not going to send you out money if you owe them money. I mean, that's the reality. Yeah.
And then another good reason is just if you paper filed your tax return. We kind of mentioned this on the other segment, but if you paper filed something, it's going to take months, maybe even years for them to process.
Yeah, here's what I would say, folks. It's 2022. It's time to use some software to prepare your taxes. Okay, if you still are getting a pencil and a piece of paper, I understand. I believe me. When I was first doing my tax returns, that's how I was doing them because that was pre-software. But the reality is, it's 2022. Time to use some software.
Mm-hmm. Yep.
It also helps with the processing of the return. Otherwise, it's just going to get into this massive machinery, and who knows what spits out the other end.
Mm-hmm.
Yeah. And then the other big issue, of course, that many people encounter, particularly when it relates to getting their refund or knowing where their refund is identity theft.
Mm-hmm. Yes. So if the IRS suspects any sort of identity theft on your account, they're going to hold the refund. And it's not because you did anything fraudulent or suspicious on your tax return. It's just something that flags in their system. So they're going to hold your refund. They're going to send you a letter that says go to this website or call this phone number to verify your identity. And then once you do that, they'll send out your refund.
So important to kind of keep track also of those letters that you might get that have a PIN number, because you're going to need that PIN number to file the return.
Yes. If you don't file that return with that PIN number, then it's going to be rejected. You won't be able to file a tax return.
And again, it's so important that as a taxpayer, if you get a letter from the IRS, if you get any piece of information from the IRS, you've got to hold on to it and preserve it in a good spot. Because we ran into a couple of issues where folks had been issued PIN numbers, but then couldn't find them. And
right.
that means that their tax return isn't going to be filed until you wait for the IRS to send you another one, which further delays the process. So make sure that if you get anything from the IRS, you put it in a safe place where you actually, not one of those safe places where you forget, okay, but a safe place that you're actually going to remember where you put it. Actually had that problem at the office this past week with some papers I was looking for, but found them. Anyway, what can taxpayers do to check on the status of their refund?
So you really have three options. You can go to the IRS website. There's a Where's My Refund tool. Just plug in the information and it'll let you know what stage of the process your tax return is in.
Okay. All right. So if I go to the website, log in, create an account, things like that, I can kind of see where I am in the process.
Right.
Okay. So that's useful. What else could I do?
So the IRS now has a phone app.
Ooh, an app for that. Okay.
It's called IRS To Go. So you can download that and also check the status of your refund.
Okay, look at the IRS embracing 2022. All right, very good. And I guess the third option is painful. What's the third option?
It's just a good old-fashioned phone call.
Yeah, good luck with that. of limited assistance, if you will. Yes. Anyway, we got to wrap it on up and get on out of here. Kristen, thanks as always for joining us on this week's program.
Yes, thanks for having me, Joel.
Good stuff indeed. We'll be back next week here on Dollars and Cents with Joel Garris.